Have you ever tried to diversify your income sources? Well, Invico has done a fantastic job on their diversified income fund. So check it out today on Money Match. Hey, welcome back to Money Match. It's Ian Ardill here. Today, I'm joined together with Jason Brooks, who is the president, co-founder, and portfolio manager at Invico. Great to have you with us, Jason.
Thanks, Ian. It's a real pleasure to be with you again here. I think it's been a couple of years since we've done this.
Yeah, Jason, we've been rubbing shoulders for some time. I was thinking back. Our family has been doing business with the Invico Dream Team since 2013. So it's been over 11 years of just awesome relationship.
Yeah, it's been a great relationship. Now with you, Ian, and your dad before that. So it's you're one of the few people that we deal with that has, actually been with the fund almost since inception, because the actual original closing on the Invico Diversified Income Fund was back in 2013. And we've worked with Raintree for the entire term of this fund.
Well, it's certainly a privilege to hang out with you. For those that are listening in that don't know anything about Invico, I'm just wondering if you can give us a snapshot of, who is Invico, and more specifically, tell us a little bit more about Invico Diversified Income Fund.
Sure, Ian, I'm happy to do that. So Invico Capital was actually founded back in 2005. And the Invico Diversified Income Fund, as I mentioned, started in 2013. So the overall today, the firm has over $3 billion of AUM. About $500 million of that is in the Invico Diversified Income Fund. It's actually the fund with the longest track record that we manage. As I mentioned, since inception, returns are approaching 10 to 11% per annum annualized, and so that's a long-term track record. Personally, I was a founder of Invico back in 2005 with Allison Taylor. So we have seen, many market cycles, both the financial crisis, COVID, and whatever else brings us in the future. So, we're a firm that is really based on, really focusing on unique niches in alternative markets. And by alternative, I mean private capital markets for the most part. And, when we look at, Invico's track record, we've won, numerous awards for credit performance. We've either been first, second, or third in the 1, 3, and 5-year returns in our category. Last year, in 2023, we won the Alternatives Solution Provider of the Year. So that's sort of the Oscars of the Canadian Private Capital Awards, and yeah, we're proud of that one as well.
Congratulations on your Oscar. Very exciting. I just wondering if if you were to take your portfolio, that $500 million is really got two significant sleeves to it. And I'm wondering if we can talk about those two sleeves, because for somebody to really understand how that money is deployed, one has to kind of understand those two complementary sleeves that's driving kind of that stabilized income source. One is on the lending side. I'm wondering, a lot of times people get concerned when they hear private debt. When you hear about, things kind of going upside down in the economy, oftentimes is a private debt fund. But you guys have had a pretty robust track record. I'm wondering if you can speak to what kind of makes you guys a little bit different on the private debt side.
Yeah, you bet, Ian. Well, so first of all, we've had credit strategies in this fund since inception. So, when we're talking about credit strategies, for us, it's really a focus on the due diligence and underwriting of every deal we do. We have a view here that is, we're not going to grow the fastest, we're not going to necessarily be the biggest, but we're going to be very disciplined so that, the most, valuable asset that we have in this firm is our return track record. And, obviously, as I mentioned with the Invico Diversified Income Fund, people are coming here for regular distributions. They want to know that we're doing our job to protect capital, and that's evidenced by the long-term track record. For instance, we've never really had more than a 3% default rate in our fund on the credit side. And we're very active when we do have problems in the portfolio. Obviously, over 10 years, you will have distress. You will have economic cycles, as you mentioned. We've been through many of them. So we really are active when we do have problems with a loan. We have the ability to restructure. We have internal restructuring capacity. My background, Allison Taylor, one of the other partners, and two of the other team members on the underwriting group all have insolvency capabilities in their past, between both KPMG, Deloitte, and myself at Ernst & Young. So when we, look at, our overall portfolio, we always look at things. Yeah, things look great today, but if there is a problem, can we get in there, muscle it out, and restructure it? And that's been a key to our success over the years. Is we don't accept loss. We work harder to make sure we protect that capital. Obviously, we're all big unit holders of our own, or as I like to say, we eat a lot of our own cooking in our own investment portfolios. So it's a critical thing.
I think one of the things that I think is very unique about you guys is how hands-on you are, not only on the entry side and making sure that you have really good quality borrowers, but how hands-on you are with those management teams when things kind of go awry. And obviously no one's looking to see things go awry, but you certainly have a fantastic track record of making lemons into lemonade.
Yeah, I know. And right now, 98% of our portfolio is performing. So I don't want to get the impression that we're just out there putting out fires. But when something gets, goes sideways, we get in there and we deal with it. And we're focusing in areas where, there isn't as much competition. We're really more in the mid-market. And the other thing that we do well here is we're really a cross-border focused firm. We're based in Calgary. Calgary's economy is more north-south than east-west. So when we look at opportunities, there's both U.S. and Canadian opportunities. That's a differentiator. The U.S. mid-market is, like a company of $500 million and up. The Canadian mid-market is actually, quite a bit smaller than that. So when we're looking at credits, having that cross-border origination capacity, looking at deals in the U.S. and Canada, finding those best opportunities, has been a real secret to being able to stay, keep our money at work, and also have a large selection of deals for which to deploy new money that's coming in on.
Thanks so much, Jason. I'm wondering if I can flip chords here and kind of just go into that other sleeve inside the portfolio. And that's really your oil and gas side of the business. And I think most people, when they hear oil and gas, depending on one's background or political view, some people get their backs up and are a little bit concerned. But I think you guys have done an amazing job at entering into the oil and gas sector in a very effective way. I'm wondering if you can speak to that, because you're not an oil and gas company, but you play in that space in a arguably very profitable way. Can you speak to that?
Sure, Ian. So yeah, what we hold in the fund, what we invest in is really more mineral rights. So we own effectively the reserves of oil and gas in the ground, and those are produced by third parties. So, in Canada and the United States, you can purchase mineral rights privately, and those are assets. Those are real property in the ground, almost like akin to an apartment building where, you might buy one floor in a 30-story condo in the GTA, and somebody else is going to run that building, but you're going to get the income from that floor. So when we buy a percentage of a reserve, an oil and gas reserve, we just buy a small percentage of the overall reserve. Somebody else is producing that. And in Canada, those people that are producer partners are very large companies, companies like Tourmaline and CNRL. In the in the United States, it's companies like Chevron and Conoco. So these are large, well-capitalized businesses that are producing those reserves. And when we look at what our unit holders get out of this, is it's income, and it's actually a little bit more tax efficient because we can do some things to structure and shelter some of that as return of capital. So the income stream you get off this, the producers pay us monthly, just like a loan would pay us monthly. They're out there marketing and handling really a lot of the operations, really 100% of the operations. But what we've built internally is to ensure that we're buying into the right areas. We have a seasoned oil and gas team that is, doing the due diligence. We have reserve engineers on staff. We have, detailed legal people that understand the land systems in both Canada and the US. Obviously, we're looking to, buy and have title to these types of assets in our fund, which we do. So it's a unique strategy. And, if you're going to be in the energy business, the key thing is that you don't control the price of your products. But what we do control is we're buying into areas with very low operating costs. We're not using debt to fuel this strategy. Typical public company will have half of the capital that they use in a given strategy or more come from debt capital markets and then equity capital markets. We don't do that. The actual reserves that are produced at what we call the wellhead, that's right in the field. That's where we're getting our economics, and we don't use material amounts of debt. We do hedging, which you can do in energy. You can sell your products forward, so we hedge up to 50%, and we're in very low operating costs. And to give you an illustration of that, typically if you're producing a barrel of oil in North America, you'll get maybe $70. Sometimes you might get 60, sometimes you get 80. During the pandemic, you might get a very low price, but these overall are reasonable prices because our actual operating costs on the same barrel is about $13. So there's quite a spread, quite a margin there to earn. So that income is what we want to distribute out to our unit holders. We do it on a regular basis.
So, Jason, at the time of this recording, it is the fall of 2024. And, there's a unique window right now in this space because of a bit of a price discrepancy. I'm wondering if you can speak to that, and why would a potential investor be looking to get involved now, or why would a current investor be really excited about holding on to their units today?
For sure, Ian. Yeah. So, the only we produce two basic commodities out of the energy working interest, we call it. One is oil. Oil's been actually fairly range bound since, of course, the lows of the pandemic. But in the last couple of years, oil's been anywhere from kind of the high 60s to maybe the low 80s in general. So not a ton of volatility, and the economics on that, as I've mentioned, have been very steady, and it's done well for us. Canadian natural gas, however, currently and for the last several months has been at near 10-year lows. So that has, slightly reduced the carrying value. And, we have a diversified portfolio of assets, but we will look at our Canadian gas assets. That's actually had a slight decline in the actual purchase price of the fund, which is based on the net asset value. So at this current time, we don't believe that Canadian natural gas prices will stay at 10-year lows. And kind of the the running line in energy markets is the cure for low prices is low prices. Why is that? Well, you can't make money in Canada on natural gas right now. So people stop drilling it, supply goes down, demand eventually recovers. Demand's heavily dependent often on weather. So, mild winter here over the last, over, 2023 into 2024, prices went down, and we had a fair bit of production because prices used to be quite high coming out of the pandemic. So that's really provided an opportunity and a window here where you're going to get kind of potentially two returns from an investment in Invico, and one of them would be obviously your distributions, which are generally running better than 8% per annum. Alternatively, in addition to that, you may get a slight increase in the net asset value of the fund because right now the low price of natural gas is reflected in the purchase price or net asset value of our fund.
So let me just catch up with you there and summarize what I hear you saying is the value of the shares or the unit value inside
Correct.
Invico is slightly down right now, not because you guys did anything wrong or made a bad investment or anything like that, but rather just a pure reflection of natural gas being down, and you, as a proportionate shareholder or owner of natural gas reserves, that brings down the price slightly. And therefore, because it's slightly down, you fully anticipate a bounce back up. And obviously, this is not a comment on guarantees or anything like that, but one would expect a bounce back up in value. And so, if you were a buyer, it's a great time to buy. Fair?
Yeah, Ian, I think that is a fair comment, and there's just a couple other things I can help to provide some visibility. So one of the things we do with the fund is, I think I mentioned, we do some hedging. So all hedging is really just selling forward your products into the future at more or less a fixed price, or what we call a floor and a ceiling. So we've already done that for 2025. We've hedged anywhere from 42% of the portfolio on, I'm speaking on natural gas, up to 60% in the United States. And we've sold that forward at the market prices that were in effect, much earlier this year in 2025. So what does that mean? Well, what it means is that we're actually going to receive on the hedging component nearly double the price that we received this year. So that is, effectively a forward sale that we know will give us improved cash flow. So even if we do nothing and the markets don't improve, our cash flows will actually improve because of the hedging activities that we've taken.
Thanks so much, Jason. I'm wondering, just walk me through the basics of the mechanics. Obviously, everyone has an individual suitability, and so they have to go through a process of trying to figure out whether Invico is the right fit for them. However, I'm just wondering if I can make some generalizations, and I'm wondering if you can walk me through the mechanics on a 3 to 5 year range of what somebody might anticipate when they invest with Invico Diversified Income. What can they expect from a cash flow standpoint, and what could they expect potentially, in terms of what's going on with the unit value? Because ultimately, when somebody invests, they're buying an actual unit that essentially has an equity component to it. So I'm wondering if you can speak to what one could anticipate on a future-looking basis.
Yeah, so the primary source of your return with Invico is distributions. And we've never missed a distributions in the last 11 years that we've had this fund. So that base distribution looks like currently about 8%. So that is what we sort of have hung our hat on for many years, being able to make that base distribution. So and then when we look at the potential for return above that, is really two sources of that. The first one is additional distributions that we might make. So if the fund earns better than an 8% return, we don't actually necessarily reinvest that growth in earnings back into our strategies. We actually pay it out to our unit holders. So their return experience is substantially by way of distribution. So from 2022 to 2023, we paid additional distributions. Part of that was the reason is that energy prices were a bit higher than they are today. So that return experience often looked like a double-digit return. So, and then the last area for opportunity with us is, as I mentioned earlier, which is this ability to buy the fund at a net asset value, and then that may go up if in the case of natural gas, we have what looks to be a return to the mean, I should say. And that's what really energy markets do. They go up and down, but they do revert to the mean. So we're at one of those points where any kind of mean reversion is going to give us an improved net asset value. So you get potentially that additional return. So if you look at like the last 3 years, that I think our compounded return was almost 9.5%. So going forward, if we do get that NAV return, we could be above that. But the important thing to remember is that, are we doing our mandate to our investors is to provide them yield. And currently in the market, an 8% yield is quite attractive, as we're now seeing the yield curve shift down substantially. Bank of Canada has started some time ago cutting rates. The Fed is as well as starting to cut rates, maybe not quite as aggressively as Bank of Canada, but nonetheless, our environment of yield is going to change, and an 8% yield is quite an attractive opportunity, particularly when you consider that part of that is characterized for tax purposes as a return of capital. So gives you a little bit better after tax result as well.
Amazing. Amazing. The last question I want to just wrap up with is why Invico? There's so many clients have trusted you over the years. Why should they continue to trust you, or why should a new prospective client be interested in trusting you? Why Invico?
Yeah, I mean, well, we've worked together, Ian, for over 10 years. We have that resiliency with the economic cycle. We crossed COVID with you. When I look at the returns of this fund, I believe, the worst years were over those COVID years, but we still gave people a 7% return. We've had some great years where it was, 15 to 20%, sometimes when the energy markets go up. We pay that income out. So, we're delivering on a mandate to be almost ballast in that portfolio for you, where you've got, reliable income streams in the future. We have over 9,000 investors in this fund across Canada. We have this, opportunity, that's present today, where we have some weak energy markets that could provide people with even a little bit more upside. So, we've had third-party validation, as I mentioned. We won the Alternative Solution Provider of the Year last year, and we've had that resiliency and track record. So we're not drifting from what we've done. We've had a lot of success over the years. Back in 2013, the first closing on this fund was $800,000, and we now have about $500 million of assets in this product. And it is my livelihood, is a number of the people's livelihood here. And we're rational people. We want to maintain and grow this annuity for ourselves and for our unit holders, as we've done for the last 11 years.
Jason, on behalf of all of my clients that are invested with you, and myself, who's an investor, it's a privilege. And thank you so much for your stewardship and your time, for joining us here on Money Match.
Thanks very much, Ian. It's been a pleasure to work with you over the years.
Thanks so much for joining us. Until next time, have a great one. Cheers.